Good morning. Hope you're all very well. Another incredibly volatile month, just to add to a tumultuous 5 years. It's been quite incredible. What a bumpy ride. We've had Trump's US-China trade wars, then the COVID pandemic, followed swiftly by the Russia-Ukraine war, and then inflation at 40-year highs, and now the second and third largest US bank failures of all time. And not to mention the end of Credit Suisse, Switzerland's second largest bank and a 167-year-old institution. It just doesn't seem to stop. And I don't think it will. We positioned for this low growth, high volatility environment 5 years ago, and we do think that it's going to continue this way. When growth is low, due to the 4Ds that you all know very well, I keep talking about, but when growth is low, any little bump you have pushes growth into the negative area. And once it's negative, well, then it has a lot of knock-on effects. We've also had free money, and I'll be talking quite a bit about that today, just the impacts of COVID and free money and how that's led to isolated pockets of instability. And that's also what we're seeing. So it's a combination of a low growth world that's seen a lot of distortions from the financial support and monetary system, which I think is going to continue for some time. Not heading for Armageddon, no great recession or great depression, but I think we are going to see a lot more volatility coming our way. But the good news is that the US bank failure is actually a silver lining. It's probably one of the best things we could hope for in terms of making 2023 a good year. And I'll explain exactly why later on when I talk about the banks and I talk about the outlook as well. But let's start with a review of Q1. And it's been a fantastic Q1. So despite all the noise that we've had, despite high inflation, despite the Russia-Ukraine war continuing, despite the Chinese and US tensions, despite the US banking failures, returns have been quite decent for the first 3 months of 2023. You can see they're up roughly 10% per asset class, although a lot of that, to be fair, is driven by the weaker rand. So the rand is 4.5% weaker over the quarter. So that has made the offshore asset classes look better, including gold, global bonds, and the other asset classes. The weakest, or almost weakest, is South African equities, up 2.8%, and that's to be expected with all the issues we've had. And I'll talk more about that on the South African outlook, but we've had the grey listing, load shedding continues, the cabinet reshuffle was a little bit less exciting than anticipated, and things still looking rather murky in South Africa. Healthcare looking pretty low there, but that's also a fantastic 2022, so no surprises. And FANG having a phenomenal bounce, 45% return in FANG. We're still avoiding FANG. We have repositioned it away from the large platform companies to try and get more the innovative companies. So we think there is upside there, but we haven't invested in that just yet. We've got enough exposure to those companies through our standard benchmark funds. But a fantastic return for those of you who were holding FANG. Well done. A good opportunity to lighten or diversify if you are so inclined. But overall, yeah, returns not looking too bad. 2023 certainly off to a better start than 2022. So the big news, obviously, in March was the banks. The March was all about the banks. So we had Silicon Valley Bank, we had Signature Bank, which became the US's second and third largest bank failures in history. We had the Silvergate Bank collapse, Credit Suisse, Switzerland's second largest bank, and US First Republic Bank also nosediving and almost failing. And markets sent a very strong signal. The markets were concerned that we were seeing a systemic bank failure, that it was a repeat of 2008, the Lehman crisis. And this chart here shows the move in the 2-year treasury. So that's the 2-year bond in the US, and it basically signals where the Fed should be in 2 years' time. So the fact that the 2-year bond fell over 1% meant that the markets were pricing that over the next 2 years, the Fed would cut rates by 125 basis points or 1.25%. And we saw the Fed actually hike rates. So what was that all about? I mean, when the market's telling you that it's a bigger concern than 9/11, bigger concern than Lehman collapse, a bigger concern than COVID, how does the Fed hike rates against the market pricing in such huge rate cuts? Well, I think it was the right thing to do, despite the markets having the biggest fall in two-year bond yield since the 1980s. The Fed did hike rates. And I think this, what the Fed's done, I think this is quite clever, and is what we were expecting to do as the US headed more towards recession. We weren't obviously expecting a bank crisis, but we were expecting bigger lumps and bumps along the way in the US, because the Fed would break down its tools and say, well, we've got interest rates which we'll use to target inflation, and that's what they did. They hiked rates by 25 basis points in March, and they are forecasting another 25 points, which may or may not happen. At the same time, they restarted quantitative easing. They used their balance sheet to target liquidity and make sure that we didn't have another Lehman-style systemic banking crisis. And I think with the fact that they do have both tools, allowed them to continue to fight inflation while solving the banking crisis. And I think it has worked quite well. But at the end of the day, despite the liquidity that the central banks provided, both the Swiss National Bank and the US Federal Bank, it came down to the market to solve the problem. And we saw that. So here you have our old friend, US Treasury Secretary Janet Yellen, saying that the show of support by a group of large banks is most welcome. I think it was certainly very welcome for the Fed, and demonstrates the resilience of the banking industry. Not so much. The Fed still had to bail out depositors, at least until the bank stepped in, and the Fed still had to, and the Swiss National Bank, provide huge amount of guarantees to the banks that have stepped in to buy those banks. But we saw the private sector basically take care of the problem with liquidity backstops from the central banks. So First Citizens Bank, they stepped in and acquired Silicon Valley Bank. HSBC bought Silicon Valley Bank UK. UBS bought Credit Suisse. And First Republic was bought by a combination of JP Morgan, Bank of America, Merrill Lynch, Citigroup, and Wells Fargo. So just as we had Africa Bank being bailed out by the big South African banks many years ago, the same thing is happening in the US. But they still needed liquidity from the central banks. So the central bank had to use both their tools, the quantitative easing and the interest rates. And we think that will continue over the rest of the year. And that's what leads us towards the silver lining that I'll be talking about later. Okay, so let's talk a bit more about the systemic bank failure in the US. And this gets quite exciting because it borderlines on conspiracy theories, which are always fun, even if not reliable. So Silicon Valley Bank went from being the 16th largest US bank with a 40-year track record to the second largest failure in the US, bank failure in the US. And it was followed shortly by Sygnia and Silvergate Bank and almost First Republic Bank. So what was the issue? It boils down to a problem with HQLA, HTM, and US Treasuries. And I'll talk about all three of those and explain exactly why. So the first chart on the right shows cumulative US Treasury purchases. Now, the red line is foreign holders of US Treasuries. You can see how foreigners have been net sellers of US Treasuries and how that's escalated in 2023 in particular. And that I'm actually going to talk to you more about in our outlook when we talk about our fifth D, which is de-dollarization. And for a whole host of reasons, central banks around the world, particularly in emerging markets, China, Middle East, other emerging markets, are preferring not to hold US dollars and US Treasuries. And that's led to the Fed having a problem. Well, because as you can see there early on, Fed was buying bonds, that's the light blue, and US banks were buying bonds, which is the light green. And then we had you can see from 2020 a huge increase in the blue area there, which was quantitative easing and the Fed buying more US Treasuries. But now we've had we've quantitative tightening started, which meant that the Fed was actually selling Treasuries. Foreigners are also selling Treasuries. So it boils down to, well, who buys those Treasuries? And I think some pressure, this is where the conspiracy theorists will step in, but some pressure was being put on US banks to buy Treasuries. And because someone needs to buy them. And there is some evidence just in terms of how it was made easier for banks to hold Treasuries, because banks don't really want to hold bonds because there is a mismatch. The first thing that was done was that Treasuries were excluded from the supplementary leverage ratio requirements, which all of a sudden makes them more exciting to hold. Why were they excluded? We don't know, but it was certainly made easier for banks to hold. The second thing that happened was that banks have to hold high quality liquid assets, so HQLA, to make sure that the banks have enough money to meet all the depositors that are there. To avoid a bank run, they have to hold more than 100% of their depositors in HQLA, high quality liquid assets. However, bonds, US Treasuries in particular, are classified as high quality liquid assets. Now, the banks, again, didn't want to hold bonds because there's a huge mismatch. Depositors are short-term and bonds are long-term, which means they have duration risk. And exactly what happened now. Bond yields went up and bond prices went down, and there was a loss that was caused as a result of those bond prices going up. And that led to a mismatch, and there was not enough money to cover all the depositors if they had to have a run on the bank. But again, they got around that. So because banks didn't want to hold these volatile bonds, they were allowed to hold them as HTM, which is held to maturity. So if a bank was holding bonds and they classified it as HTM, held to maturity, it means that the banks didn't have to recognize any losses on their income statement or even their balance sheet from the losses in those bond prices moving up, because they weren't marked to market, they were just held to maturity, which is fine when things are going well. But the moment, and this is what happened to Silicon Valley Bank, the moment you start to have a run on your deposit base and you need to access those HTM, HQLA bonds, well, you can't without leading to all sorts of problems. And that's exactly what we had. So there is a bit of an issue because the amount of bonds being held by banks as HQLA is more than double what it was in the past. And that's possibly because the Treasury needs someone to buy those bonds. But it does mean there's a mismatch, which is a concern in terms of a systemic risk in the US banking system. But the good news is that Silicon Valley Bank was different for three reasons. The first reason is the bottom right-hand chart. It just shows the amount of bonds that they were holding as a percentage of their assets or their deposit base compared to other banks. So you can see that it was more than double what the other banks are holding. So that was certainly, they were an outlier in terms of the duration mismatch, the asset liability mismatch, and that was a big part of the problem. The second issue is that they held assets just below $250 billion, and that's the level where regulatory oversight increases. So you have to hold more capital, amongst other things, and be a lot more cautious with what you do. And not only were they keeping the asset base just below that level, but they were even lobbying for reduced regulatory oversight. And we also saw how that went for them. But the third issue, and that's why it also doesn't apply to all other banks, is they had a concentrated asset client base, sort of deposit base. Silicon Valley Bank was the partner of choice for almost half the US-backed techno startups and venture capital funds. So when we had the slowdown in VC because of interest rates going up and the free money disappearing, well, that whole client base relied on withdrawing money from Silicon Valley Bank. So it was the three factors which all tied together, which made Silicon Valley the problem child. And then the Signature, which was linked to the same client base, also saw a run on their clients. And Silvergate, which was not quite linked, but they were linked to the crypto space, which also seen outflows because of FTX.com. That also saw some outflows. So there was all very much linked in terms of the client base, which combined with the other two factors made for the end of those banks. But the good news is that it doesn't seem to be, even though there is a systemic risk with higher bank holdings, it doesn't seem to be that the failure of these banks is going to cause the failure of any other US banks anytime soon. In fact, the systemically important financial institutions, SIFIs or SIFIs, are much stronger now, with far higher capital levels than they had in 2008 when we saw the great financial crisis. In fact, some of them have as much as 4 times the capital base that they had in 2008. So certainly, there's a much more stable and robust large banking system in the US, and we are likely to see further flows of money from the regional and smaller banks into the larger banks, but we don't foresee any systemic collapse of banks in the US. But this is when it comes down to our silver lining. Every bank has been squeezed by the 475 basis point hikes, and even before the collapse, US banks have started tightening their lending standards, and that's going to continue. So growth is going to slow in the US because of tighter lending standards, and because of these bank failures. And that's exactly what the Fed's been trying to achieve. The Fed's been trying to achieve slower growth to slow down inflation by hiking rates. But now the Fed can hike rates slower than they would have in the past. So they might have done a 50 basis point hike in March, they only did 25, and they might not do another hike for the rest of the year, or they might do 25, but they were thinking of getting close to 6%, which is certainly not going to happen. So what we are seeing is slowing of growth in a different way, which is good for the rest of the world. The US is still going to see slow growth regardless, but the fact that US growth is going to slow because of the banking system means the dollar is going to weaken, and that's good for the rest of the world. So we do think that when we remain under at the US, not only is the dollar going to weaken, but also we are seeing much higher chance of lower earnings because of tighter banking standards that are going to come through later this year. So US recession is still on the cards for later 2023, early 2024, and so that's still part of the reason why we are underweight the US. Another interesting reason, and part of the de-dollarization theory, is the fact that the Fed, and why we think that weaker dollar is on the cards, is that the Fed is now forced, because of this QE, because they're taking all the banks' assets onto their balance sheet. The Fed is now being forced to take on lower grade assets from the banks as part of this bailout. So all of a sudden, the Fed is not holding as high quality assets as they were. And this started in the 70s when they stopped holding gold, or holding a lot less gold. And over time, they've been holding, as quantitative easing has started, they've been holding less and less quality assets, which on one hand does lead to high inflation, but also on the other hand, the rest of the world thinks, well, maybe we're not going to buy US treasuries because the assets that are backing the Fed and the US aren't as high quality as they used to be. So bottom line is, this is pretty bad for the US, good for the rest of the world, and but not an issue that's going to cause a systemic failure or global recession in the next 6 months, but could lead to the US recession happening faster than expected, or sooner than expected. So lots of excitement happening in the US with the banking system, and Europe with Credit Suisse, but things haven't been quiet either in China. Xi Jinping rallied the Chinese private sector, saying that the comprehensive containment and suppression by the US over the past few years have brought unprecedented and severe challenges for China's development. Basically, China is tired of all the attacks from the US, and the US trying to rally its partners, Europe and Japan and Taiwan, to try and contain Chinese growth. So the US did respond in a positive manner, and they said that they did not seek to contain China or have a new Cold War. That's from the US State Department. Doesn't mean much, but they are at least saying the right things. But I think China is just getting on with what it wants to get on with. And this is, again, part of our de-dollarization, our 50, which I'll be talking more about at the end. But we saw a number of data points which point to the fact that China's just had enough. Now, we must remember that China is the biggest global trade partner in the world. A decade ago, it was the US. Now it's China. China trades with more countries, far more countries in the world than the US. In fact, the US only trades more with Mexico and Canada, and China trades more with every other country, roughly, in the world. And China's decided to just get on with it. So the first thing that China did in March was Xi Jinping met Putin in Moscow for conversations about the Russia-Ukraine war, which were described as frank, friendly, and rich in results. Now, we didn't really see any results, but the fact that China is there means that they're starting to create their own discourse, and that's pretty important, especially when it's tied in with the second point, which is that China has brokered a peace deal between Saudi Arabia and Iran, leaving the US on the sidelines. Now, the US has been trying to do this for decades. The US has been meddling in the Middle East, as we all know, for decades, for possibly not the best reasons. And I think that's going to be, I think the Middle East is quite well aware of that. And again, the details of this peace deal between Saudi and Iran aren't clear, and there's not much that's spoken about in terms of the nuclear deals, but it's still a peace deal without the US. So again, China is stepping in and creating discourse with other countries. And that's led to a third point, which is that the Saudis have now expressed interest in joining the Shanghai Cooperation Organization, which will see the end to a 1945 deal between Saudi Arabia and the US, where Saudi Arabia agreed to exclusively sell oil in dollars. If they do this and Saudi moves away from selling oil in dollars, well, that's a huge blow to the dollar. And not only that, but a fourth point is that a few days ago, China and Brazil agreed to a deal that will see trade between their countries in their own currencies. So we're starting to see a new axis of power that's emerging with emerging markets, the Middle East, China, and all because the US is throwing its toys out the cart right now and being incredibly difficult. So the rest of the world is being forced to go their own route. And we're seeing the same thing in the oil market with the sanctions that have been put in place. Right now, the US is pretty much energy independent. Europe is taking the brunt of all of this, and they're forced to pay higher prices for their energy. But everybody else that I've spoken about that is working with China and the Middle East and Russia are buying oil at a discounted price. So we're definitely seeing three different bodies that are in play. Europe is unfortunately the loser on this, because not only is Europe a much larger trading partner with China, but they're having to pay much higher oil prices. So they're losing out on both. Whereas the US is sitting pretty, they don't trade as much with China on a percentage basis, and they're energy independent. So they're forcing all of the stress onto Europe. And everyone else in the rest of the world is kind of getting along and just ignoring the US. So a lot of politics happening this month between the US and China. And I think it's quite interesting when we look at the chart on the right, which shows the US retail trade sales against China retail trade sales, both in dollars. And it's probably a lot worse with, purchasing power parity basis, where China is probably a lot higher. But anyway, just the worst case scenario, which is just dollars. The US consumer has always been considered the consumer of last resort. Manufacturing is the first industry that slows down in a recession. Consumers are more resilient. You have to still pay for electricity. You have to still buy food. And so consumption continues. And consumption makes up a much bigger portion of the US, 70% of GDP. So the US has been more resilient. And people have said, well, will China make up for the US if the US slows down and China continues to rally, with consumption only nearly 50% of its GDP? But what is quite surprising is that before COVID, China eclipsed the US as the world's largest consumer. And we all knew we were going to get there, but I don't think many people realized that in 2020, China actually eclipsed the US as the world's largest consumer in dollar terms. Then we had COVID, and you can see there the blue line is this tick up in US consumption, where the lockdowns were more severe. Well, lockdowns were just severe, but people were sitting at home, and the furlough and the checks that were written were far more supportive. So people they couldn't spend anything on services. They had a lot of extra money, so they spent it on goods. And that's why there's an elevated inflation in the US, because there was this unnatural good demand. China, on the other hand, was locked down severely, and their consumption, as you can see on the gray line, dropped quite significantly. And that was even into 2022, when the most severe COVID lockdowns happened. But as China reopens, Chinese consumption is going to rapidly catch up. And we saw that in the retail sales, Jan-Feb, up 3.5%. So retail sales rapidly accelerating in China, and likely to catch up with the US very soon. So we continue to be very bullish. China, we think you can't ignore this region. Yes, there's a lot of risk between China and the US, but with China being the largest trading partner with the rest of the world, it can't be contained. And certainly Europe and Taiwan and other emerging countries are going to be a lot less excited about any of the constraints that the US is putting in place. Meanwhile, China continues to support its own country. The PBOC cut the RRR, required reserve ratio, by 25 basis points. say that fast 3 times. And we also saw that China's National People's Congress set the broad budget deficit for 7.5%, which is much higher than 2022. So both fiscal and monetary support in China continue to be strong, and we continue to overweight emerging markets and China. I think there's more to come. Moving on to South Africa. So we had an appointment of the new electricity czar, here he is saying, I see myself as a portfolio manager addressing the multiplicity of programs. Now, when I first read that, I had a slight panic attack because that sounds more like boardroom bingo than it does actually fixing anything. But he came out with some good statements. We had the chairman of Eskom applaud Eskom after 6 of its plants registered the EAF above 70% for the first time in a year, which I suppose is a good thing. But our electricity minister said the fact that a monopoly issues a statement to celebrate such performance is just an illustration of the crisis, which is spot on, because we've got the privately owned Kelvin power station, which continues to boast an EAF of above 80%. And that's what we should be aiming for, not celebrating 70%. And now, unfortunately, with the latest move from Treasury to exempt Eskom from disclosing irregular and wasteful expenditure, well, things have just gotten murkier and murkier. It's truly a very concerning move. Well, hopefully we'll find out more, and hopefully Treasury can be taken to court and this can be unwound, but I don't know why, when we're trying to fix Eskom, why we want to hide what's going on inside. As I mentioned, President Ramaphosa reshuffled his cabinet, not quite as big a reshuffle as people were hoping. And unfortunately, 2 additional ministers were added and 2 deputy ministers, which took the largest cabinet in the world to an even larger cabinet, which again is not quite what we're looking for in terms of reforms and cutting costs. And at the same time, GDP took a hit, falling 1.3% in Q4 on the back of load shedding. We had S&P downgrade SA's credit, which was unfortunate. And similarly, we had IMF downgrade SA's 2023 growth to 0.1%. Basically, we're looking at a recession this year in South Africa on the back of 2 things. Load shedding, which you understand, and the lack of exports because of Transnet, but also, unfortunately, because of weaker commodity prices. And what's happened is we've missed out on the commodity party. Commodities move in cycles, and we've had a fantastic commodity cycle as China has slowed, so the commodity prices have come off. And unfortunately, we weren't able to sell our commodities because load shedding meant we couldn't mine them, Transnet failure meant we couldn't export them, and hopefully we'll get things sorted out. But by that time, the prices aren't where they were. So the windfalls that we should have had, we've missed out on. And as a result, we saw South Africa have its first current account deficit in 3 years, which is not great. And then the rand has weakened from other emerging markets and developed markets. So chart there on the top right shows the rand. In pink is the JP Morgan Emerging Market Currency Index. Blue is the dollar index, which is basically US against its developed market peers. And the dark blue is the rand dollar. And you can see there, this is a 1-year chart for the first 6 months, basically till November last year. All 3 moved in line, all being driven by the same factors. And then in November, December last year, we started to see the dollar weaken against its developed market peers, the euro, the yen, the pound, but emerging markets and the rand, so the pink and the dark blue lines pretty much moved in tandem, not as strong again as euro and yen, but moved in tandem until Feb. And then you can see the huge divergence between the rand and the purple line and the pink line, the emerging market currency basket on the back of our own issues. So that's the grey listing, lower commodity prices, load shedding, and all the other things that have happened. So there are some silver linings. The one is that the fact that the bottom right-hand chart shows that, and this goes back 10 years, that the rand has got the highest level of shorts, and that shows the number of contracts that are short the rand in history over the last 10 years at least. So that means any even neutral to good news means the rand is going to strengthen. And because load shedding not only led to weaker growth, but also pushed inflation up because of diesel costs and the knock-on costs of retailers, businesses, while inflation rose, and that forced the SARB to raise rates more than expected, 50 basis points, which also helped the rand rally slightly. So we're now back down below 18 rand to the dollar. And I do think that EM currencies and the rand will converge as load shedding slowly gets better over the rest of this year, and because of the incredibly high level of speculative interest, the net rand short position, and so we are expecting the rand to be closer to 17 at the end of this year, and not above 18. But that is obviously reliant on the private sector to bring on enough supply to reduce load shedding towards the end of 2023, and we do think that is likely. Okay, so how does that bring us all together in terms of positioning? What is the silver lining? Well, the silver lining, as I mentioned, is the banking crisis in the US. And that's, if you look at the top right-hand chart there, you can see that bank tightening has already started in the US as those lines move negative. So bank lending becomes tighter, and that's only going to accelerate as a result of the bank failures. Banks are going to become more cautious. They're going to lend less money, which means it's going to be harder for people to grow their businesses, to start new ventures, and people will start to save more because they're earning higher rates on their bank interest, and the whole thing's going to slow down growth. And that means the Fed doesn't have to hike rates as much as they had to in the past or expected to, and that's good. That means a weaker dollar. It means lower cost of capital for the rest of the world, and that means the rest of the world growth, particularly EM, can recover faster this year than otherwise expected. So it really is it really is a good thing for the rest of the world, the US banking crisis, particularly for emerging markets and China. The other thing that is good is that quantitative easing is back, and that means the Fed put is back, really. And markets tend to rally when the Fed put is back, and market tend to fall when the Fed is doing QT, quantitative tightening. And you can see here, the bottom right-hand chart shows that over the 2 weeks of March, assets on the Fed's balance sheet increased by 392 billion, basically unwinding nearly 70% of the quantitative tightening that the Fed had done. And that was pretty much the result of banks using the two Federal Reserve bank stops that were in place to provide liquidity to those banks. And yes, some of those might come down as the banking crisis unwinds, but we've still seen a huge increase in liquidity and QE. So despite a small interest rate hike, we are expecting to see fewer hikes at the end of the year, to the end of 2024. Plus, you've got QE supporting liquidity, and that means things are looking good in terms of the rest of the world, at least, avoiding recession. Certainly, US recession is still likely for the end of 2023, maybe early 2024. But the rest of the world might be strong enough by then to keep the world as a whole out of recession. And I think an incredibly important point is that at the recent Fed meeting, the Fed hiked rates by 25 points. That's given. They're forecasting another hike of 25 points this year, which may happen. But and this is a game changer, and it's part of our silver lining outlook. In 2024, they are forecasting rate cuts. They're forecasting rates to fall to 4.25%, which if they hike another 25 this year, means 4 cuts next year. But I haven't got to the good part. The good part is that they are saying they'll do this even though they're forecasting inflation above their 2% target for 2024. So they're basically saying inflation can stay high for longer, and interest rates can start to come down. Now, interest rates will still be high. I mean, it's 4% is certainly above the long-term targets. And that talks to our theme of high interest rates, high inflation, and high volatility over the next year. But it does mean the Fed's not looking to panic. The Fed's not looking to cause a global recession by hiking rates too much. And I think that's the one thing that the US banking crisis has taken off the cards. Yes, before there was a tail risk that the Fed could panic. Even though inflation expectations were under control and wasn't our base case, it still was a relatively high likelihood. That's gone to almost 0% chance, because the Fed is now saying that they are going to accept higher inflation into next year. So still data dependent. We'll still see how quickly inflation rolls over. And the PCE numbers that came out a few days ago, US PCE, were better than expected. So inflation is still on the right side, which is good. So it allows the Fed to have this positive rhetoric. Things could change, and risks still exist, and the Russia-Ukraine war could still escalate. But our base case is that a Goldilocks scenario where inflation continues to roll over, and the Fed continues to be conservative because of the US banking crisis, and that keeps the dollar weak, and that keeps the rest of the world growth strong, and that's good for risk assets. So it does mean we are overweight non-US equities. We remain overweight South African bonds, but with Rand protection. So we've got some derivative protection on the Rand to protect against Rand strength. We've got overweight US value and global value and healthcare because of higher inflation and higher rates. And during the month of March, we did take advantage of the volatility, and we did take profit on some of our short-term protection, although we do still have some short-term protection in place. But again, I think it's very important to point out what I opened up with, that the environment we're looking at is a low growth environment. It's a high volatility environment. But what we are seeing, we saw the Silicon Valley Bank collapse in the US. Data point. We saw Credit Suisse collapse in the EU, second data point. But we think these are more likely tied to other data points, like the collapse of FTX.com, which saw a tailspin or nosedive of crypto assets, and the UK liability-driven investment ALM mismatch, which saw the pound go into tailspin. All four events in the euro, in the pound, in the crypto space, in the US, they're not linked. Well, they are linked, but they're linked by free money. They're linked by the COVID free money, which led to imbalances, pockets of fragility and pockets of imbalances around the world. And that's what we're seeing. And we do think that more of those pockets exist, and there is going to be more volatility. But we don't think those pockets are linked in a systemic way that's going to cause a global recession. We just think that there are risks that are out there. And when the pound went into a tailspin, we said the same thing. We said, yes, this is an isolated event. There are more isolated events that are going to happen. We didn't think that the next one would be in the US banking system, but it has turned out to be. And so now we have seen a bubble in US banking. We have now seen a banking bubble in the UK pension industry. We have seen a bubble in the crypto space. We have seen a bubble in, well, Credit Suisse is possibly not a bubble, but certainly management didn't do the right things during COVID with free money. But all of these are just symptoms of the incredibly high levels of monetary stimulus, quantitative easing, zero interest rates, negative interest rates even, that we saw around the world. And as the world starts to acclimatize to high interest rates, well, as the tide goes out, as Warren Buffett likes to say, we'll see who is swimming naked. And certainly the US banking system, well, not the banking system as a whole, but some of those US banks, Credit Suisse, FTX.com, UK pension funds, some of them were all swimming naked and have been caught out. But we remain overweight global equities. We don't think that there's a global recession on the way. We remain underweight South African equities because of headwinds to South African growth. So just looking at our four growth headwinds: decarbonization, deglobalization, debt and demographics, our 4Ds, and our growth opportunities, our satellites, which we use to invest, to look for pockets of growth, sustainable economy, emerging consumer, disruptive technologies, health innovation. Those are still on track. We still overweight those. But as I've mentioned, we are looking to add a 5D, which is de-dollarization, which is basically the rest of the world besides Japan and Europe starting to look at trading in their own currencies as opposed to trading in dollars, and holding their their FX reserves in gold or non-US treasuries. So that both of those are going to see headwinds. Slow. We took this, these are strategic 10-year, decade-long headwinds that we're talking about. But we think de-dollarization is probably a fifth one that can be added to that because of the geopolitics that's going on. And until now, all the the geopolitics that have happened, the US has always been the winner, the dollar has always strengthened, and US growth has remained strong, and China's taken the brunt, and emerging markets have taken the brunt, and the rest of the world has taken the brunt. That we think that is starting to change, and US exceptionalism is no longer as strong as it used to be. Okay, that's it for today. Let's have a look at your questions. Anonymous asks about risk-off environment, correlation between risk assets and defensive assets approach. One, yes, certainly. I mean, we have seen that happen. Generally, in risk-off environments, asset correlations tend to one, and you know, all assets tend to fall and all assets tend to recover. We have seen some of that happen. Certainly, in the beginning of the banking crisis, it was when there was a concern that the failure of Silicon Valley Bank was going to lead to a global financial crisis. We saw correlations 10 to 1, and all asset classes fell. But we now start to see people discriminate. As there's a realization that that specific pockets that are in trouble, and so emerging markets have recovered very nicely. China has recovered very nicely. Europe has had a phenomenal Q1, best performing region, as you saw besides the FANG stocks. So markets are differentiating between different asset classes, and so the correlations are starting to lower between different asset classes. But it remains a risk. I mean, the world financial systems are so interlinked that it's difficult to find asset classes that don't tend to win. And I think this is my concern with buying gold, is that gold also tends to a correlation of one when risk is off. Yes, with the US crisis itself is quite interesting, because there was a crisis about confidence in the US banking system. And so Bitcoin had a fantastic rally, gold had a rally, as people looked for decentralized banking alternatives. But again, those have started to reverse, and you know, as those correlations have unwound. But you know, when it comes to a proper risk-off event, there are very few places you can hide besides cash. And one of the ones that used to be uncorrelated was global bonds, but because of quantitative easing, those have also now been thrown into the correlation of one bucket. So it's tricky. US cash, diversified basket of cash, certainly what we hold to protect against risk-off. So we hold some dollars, some euros, some yen. And we think that's the best defensive position you can get in a risk-off environment. Yeah, Anonymous, again, you spot on about the bank term funding program being QE. It is QE, and you know, bailing out of the banks does lead to moral hazards. I don't know if any of you have read signals you put out yesterday, but we certainly said that the problem with banks that are too big to fail is that they are too big to fail. On the one hand, you are protected from a nationwide shutdown, but at the same time, it does lead to moral hazard of banks taking on risks because they know that they'll be bailed out. So certainly it is a problem with QE. Yes, a recording of the webinar will be made available. All our webinars are available on our YouTube channel. So just to have a look at the Sygnia YouTube channel, and you'll see all our all of our webinars there, not just the market and eco webinars that I put out, but there are some fantastic other webinars that my colleagues put out. Renia asks, what is my take on the BRICS new currency that will be backed by gold? Yeah, I think that the BRICS, particularly China, is and there have been rumors for some time that that China is looking to put together a BRICS currency. The last I heard was that it was going to be some sort of digital currency. I don't know if it can be backed by gold. I don't watch the space closely, but to have a gold-backed asset class is also something that was proven didn't work. Having a cash-backed currency also doesn't work. So certainly when the Fed starts to take on all sorts of unsavory assets, well, there's a chance the dollar will weaken. For now, the dollar is holding up though, so we'll see. I think we are moving closer and closer to a non-dollar currency. What that looks like, whether it'll be a digital currency, whether it'll be a basket of currencies, whether it'll be backed by gold, I'm not sure. I think it'll be some time before the BRICS manage to agree on an idea. It might be one thing for China to create a peace deal with Saudi Arabia and Iran and go and visit Russia and talk about Ukraine, but to actually get a solid outcome is a bit more difficult. Mike asks if we still overweight South African bonds. Yes, Mike, we still overweight South African bonds. Yes, the weakening rand has worked against bonds, but your carry, if you're just holding that position, if you're not worried about capital, if you don't have to sell that position, if you're just living off the income, you're still getting 10.5% yield. So we are overweight South African bonds because of that decent yield, and we do think that bond yields will continue to come in. Bond yields have come in, so we did have a great month for bonds in March, and we do think that as the rand strengthens a bit more towards the end of the year, and as the US bonds also strengthen as they have, that bonds will see better returns going forward. So we are still overweight South African bonds. Anonymous asks, if interest rates rise in South Africa, do bonds generally follow suit? No, not always. And we saw that happen when interest rates were pushed up 50 basis points. So the front end of the curve went up, but the back end of the curve hardly moved. It did move a bit, but hardly. So we saw the curve flatten, and that means that because growth is being slowed down by a more restrictive monetary policy, means inflation is less likely, and so the inflation premium comes down, and so your bond yields can fall a bit, and that's exactly what we saw. And as that bond yield flattens, it also moves closer to predicting a recession in South Africa, which most economists are predicting. So the fact that we had a very steep yield curve was quite unnatural. So I think we saw a reasonably sensible outcome with bonds going up 50 basis points, with money market interest rates going up 50 basis points, and the yield curve flattening as a result, and bond yields not moving too much. Bradley asks a very difficult question. Where do you see the dollar in 10 years? If the dollar does fall as a reserve currency, what do you think the impact on the US will be, especially their debt? So the good news for the US is that they can't default on their debt because it's in dollars. And that's what keeps US exceptionalism alive, if barely, and that's what allows the US to get away with the terrible things they're doing. As I've said before, if the US is basically doing what the UK tried to do with their very aggressive budget that saw a change in prime minister, but the US can get away with it because they are the global reserve currency. So first of all, where do I see the dollar in the short term? I think interest rates are going to stay higher because inflation is going to stay higher. And so I do think that the dollar bond yields could rise over the next year, not in a hurry because things are still quite uncertain now, but I think bond yields could rise slightly in the short to medium term in the US. Longer term, if the dollar does start to lose some of its resilience and becomes less of the global reserve system for the world, then the US bonds could certainly see a further weakness. As I said before, we've already got the Fed trying to sell bonds. Well, now they're buying them, but the Fed was trying to sell bonds. So we start to see QT, the Fed selling bonds, foreigners selling US bonds, banks a lot less likely to buy US bonds now because after SVB got burnt. Well, then who buys US bonds? It may get to a point that they're just so attractive that people start buying them from investment perspectives, but you could see some weakness in US bonds. Certainly, we don't hold any US bonds in our portfolios. Nick asks what I mean about demographics and headwinds. So Nick, one of our 4Ds is demographics, and it basically talks to the fact that populations are aging. So I started with Japan 20 years ago. Europe got there 10 years ago. China's there pretty much now. The US is probably going to get there in about 5 years' time. And it talks to the fact that populations are aging. So you've got fewer people entering the work labor force and more people exiting as they age, particularly the boomer generation. As the boomer generation starts to retire, the working age labor force will shrink. And that has a whole number of implications. But the biggest one is slower growth, because GDP growth is made up of two things. How cleverly you work or productivity, and how many people are working, or labor growth. And if you have a shrinking labor pool because more people are retiring than entering, or your growth just slows. Slower growth is a headwind for global growth. It's a headwind for earnings. On the flip side of that, as those boomers retire, so they're going to start spending exponentially more on healthcare, which is why we like healthcare. We also like countries where there's still positive demographics coming through and new people entering the labor force. And that's mostly emerging Asia, which is why we like Asia. Why not Africa? Because Africa's got the highest population growth in the world, because it's not just about people, it's not just about the number of people, it's the number of people entering the workforce. So it's a combination of high birth rates and high quality education systems. And unfortunately, Africa as a whole lacks the education regime that we are seeing in the East. A question on the property market in South Africa. Okay, that is a great question. Property has been the worst performing sector in the first quarter. It's down 5.5% in Q1, South African property. The worst performing sector or asset class or sector that we track. So property is starting to look pretty attractive relative to other asset classes, such as South African equities, which have rallied quite nicely because of the weaker rand. And so property is starting to get a bit more attractive. We have increased our property allocation in our absolute funds, but we haven't changed our SIA to add SA property. So long term, we still think property has a negative outlook, but in the short term, we do hold global property in our global equities, and we have added SA property to our absolute and income funds, where we think that they have been hurt quite a lot in the short term. Yes, there's still a lot of risks about South Africa, so they might stay cheap for quite some time, but the yield is looking attractive. Andre asks about the relationship between debt. So again, talking to the 4Ds, so demographics is one of the reasons why growth is slow. The other D is debt. So debt is unfortunately at a global all-time high. Whether you're looking at governments or consumers, it's all-time high. And what we've done is we've managed to grow our way out of crises, whether it was the great financial crisis of 2008, or Brexit, or the Chinese shadow bank crisis, or all the crises we've had. We managed to grow out of all those crises by taking on more debt, actual physical debt, or quantitative easing, or low interest rates, meaning companies take on debt and do share buybacks, or consumers gear. All of the whole financial system has geared. I mean, it's sitting at the highest levels of debt to GDP in history. Why is this bad for growth? Well, because interest rates are now going up. Well, first of all, debt's at an all-time high, so you're going to be paying. But as interest rates go up, you've now got a double whammy of all-time high level of debt plus high interest rates. Interest payments go up. That interest payments have to come from somewhere. So firstly, they come from some of the easy things like research and development. So that means slower growth. Then they come from of the companies themselves. Then they come from other areas like marketing or job growth. And again, it leads to a slowing economy, slower growth. It also impacts earnings directly because you've got high interest payments. So growth starts to slow, and companies start to scale back. So high debt levels is bad for growth, just as aging demographics is bad for growth. And in a low growth world, when your global economy is growing slow, it means two things. One, that any bump means you'll probably go negative, as opposed to if you've got high growth, you get 5% growth and you fall 3%, you still got 2% growth. If you get 2% growth, you fall 3%, you're at -1. So more recessions. But it also means that you have to find other pockets of growth. You've got to find things that are still working when the world is not growing, and that's our global theme. So we do think that climate change, sustainable economies, the move to renewables, that's all going to grow as traditional energy sources slow down. So that is a protected growth environment. Healthcare, as I've mentioned before, is a protected growth environment, and disruptive technologies is also a protected environment, because even though the world is slowing as a whole, the fantastic companies in the Fourth Industrial Revolution Fund are finding new market shares to create sales. So yes, you might not be spending as much money as you did on your traditional things, and you might be scaling back on the amount that you spend because interests are going up and petrol prices are going up. So maybe you're not buying a new TV or you're not buying a new car, but yeah, you might be buying some fancy new tech gadget that's come out of fourth hours, such as VR, virtual reality goggles or something like that. So new market shares will still grow even in a slowing world, and that's how we have disruptive technologies as a protected growth environment. Derek asks, is it now time to switch out of holding the US dollar, and if so, into what currency? So Derek, it's a great question. And I think it's, all our 4 or 5 Ds now are strategic themes that we talk about over the next decade. So the dollar itself is far more difficult to predict in the short term. Right now there's some risk off because of the US banking crisis. We could see the dollar strengthen a bit more because of the risk off environment before it starts to weaken in the longer term. But we do think the dollar will weaken in the longer term. There will be short-term volatility. The best thing to do is to diversify. So if you only have dollar cash, when you start to take more money offshore, well, think about putting some in pounds and some into euros and some into yen, and having a more diversified basket. That's diversification is certainly the safest thing. There's no rush, but I think if you start to diversify your foreign currencies into other asset classes, and maybe even some other EMs like China, if you can, renminbi as another asset class, it's a good diversification. George asks the fantastic question, which is unfortunately not easy to ask. Is gold a good store of value in a crisis? So yes, it is, because gold rallied very strongly on the banking crisis. Is gold worth buying? Well, I don't think so, because if you look at gold, which is supposed to be a store of value, it's incredibly expensive as a store of value. And that's because quantitative easing caused it to revalue. So I do think gold's going to have headwinds as US interest rates start to go up and US bond yields start to go up. So it's difficult because you want to hold some gold just because in terms of having a hedge in the crisis, but finding a good time to buy gold is difficult, and we certainly don't think now is a good time to buy gold, so we haven't got any gold. John asks, what is our view on global bonds? I do think that global bonds will see further upside, because yields will see upside because inflation is going to be here for longer. They are showing more value, but I do think that there's yields can also go higher on bonds. So I suppose the easiest thing to say is we don't hold any global bonds. If we had to hold some bonds, we'd probably start to think about Chinese bonds or emerging market bonds, but we don't hold those either. Neil asked why US value is still a hold if the dollar is declining. Neil, as I've said before, the dollar is going to decline, but slowly and over the next decade. So, we certainly, our biggest exposure, even though we're under the US, our biggest global exposure is still to the US. It's still the largest global GDP provider. It's still the cleanest shirt in the laundry basket. And so it's still worth having some US exposure. Value is more protected against high interest rates, because as inflation stays high and as bond yields stay high, value will do better than growth. So we think that value is the place to be. US value actually looked like a good buying point last week, because US value does have a high allocation to US bonds. So it got hurt a bit over the last month, and we did top up our US value exposure when it ticked down because of the banking crisis. We do think that there's more upside there, despite the concern about US banks. Lynn asks another great question. Any thoughts about the energy markets short term? Will increase in oil price push up inflation? Yeah, Lynn, I was going to address that in next month's webinar, but I'm sure all of you saw. I have a great chart, which I'll show you next month, that OPEC pushed up or cut supply by 1 million barrels of oil a day, but it's all about OPEC's ability to enforce that. And I think that is limited. So yes, oil prices have spiked, knee-jerk reaction, but I think if you look at how much oil OPEC is pumping, it's way above what they say they want to. So it's one thing saying, yes, we're going to cut supply. It's another thing telling countries to stop earning revenue and stop producing oil. So easier said than done. Anonymous asked about de-dollarization. Well, it does mean that the rand will strengthen over time against the dollar as the dollar weakens. So we've got our own issues, but yeah, certainly all currencies should strengthen against the dollar. Anonymous again, can I ask a favor, everybody? Would you mind putting your names down for questions? It's quite difficult. Some people send through questions, like 3 questions in a row, and if I know it's coming from the same person, I can link those together. But if it's anonymous, I don't know if it's the same anonymous or a different anonymous. So yeah, please can you from next month, please just put down your name. First name is fine, or even an exclamation mark. But as long as I can see that it's a different person asking a question, it makes my life much easier in terms of answering those questions. I mean, I don't want to do a poor job on answering questions, but if I can't link them together, then I can't answer them. Yeah, Mr. Nakas points out that there are still risks, that there could be another 200 banks with liquidity issues. And yes, I don't think we're through the worst of the liquidity crisis, particularly some of the smaller banks, but I do think that there's not going to be a systemic crisis in the US. Sorry, just hit 12 o'clock, so I'm just going to go through the remaining questions quickly. China, Anonymous asked, China and the Middle East are striking some game-changing deals. Yes, certainly. How does this affect SA? Well, SA has been lumped in with the BRICS, whether we like it or not. SA is seen as a favorite of Russia and China. So I'm sure we'll get thrown in with BRICS, with the good and the bad of that. Vuyo asks a great question. With the introduction of ChatGPT-4, do you see any material changes in the financial markets in the coming years? Certainly, and we actually are going to, Sygnia is going to put together a webinar on LLP, AI, which ChatGPT is an example of that. Basically, linguistic machine learning programs, and we'll take you through that in the webinar and the implications and the investment opportunities. So Vuyo, keep an ear and eye out for our webinar on that. Tom asked a very long, good question about the world splitting into the US versus non-US, and capitalism versus socialism, and how markets are going to handle that change. And it's certainly not going to be easy. And I think there is going to be a lot of volatility that happens, and there are going to be risks because capitalism, by its definition, should be better for capital and investing than other regimes. But at the same time, we have seen the US and Europe and the UK treat their capital incredibly badly with negative real rates for quite some time. So the question is, what is good for capital and what is bad for capital is more of a nuanced answer. Yeah, I could do a whole webinar on that alone, John. Yeah, John asked a good question. If you expressed previously was the one that one should hold Western companies that sell to China rather than Chinese stocks. Your view now is to hold Chinese equities directly. It's also a great question, John. I think it's. I'm not saying. I think you can do both, and certainly we hold some incredibly large cap companies in Europe, from the Stocks 50 ETF. Some pretty large companies in the US with the S&P 500, and those and in the FTSE 100, and those global large cap companies certainly have exposure to China. Not least of which we've got South African companies like Richemont. And British American Tobacco and Naspers Process, all with exposure to China. So I think there's a lot of Chinese exposure through global companies that we have exposure to, and that's working. I mean, Richemont's share price has been doing phenomenally well. But I think what we are going to see, and again, it talks to our, our 5Ds and the fact that we are starting to see some de-dollarization and some more focus on make your own country great again, like we're seeing in the US, like we're seeing in China, and that sort of nationalistic rhetoric will cause people to start favoring their own brands, or it will cause supply chains to make it easier or cheaper for people to provide goods in their own country. So whether it's that people start to buy Chinese luxury goods instead of Richemont luxury goods, or whether it's because Chinese consumers start to prefer their local shoe companies to Nike, well, I think there's definitely going to be a move away from globalization to as one of our these deglobalization to supporting local, and I think that's I think you need a combination of both. Certainly, the large companies you have to hold; they're huge weights in the index, and they will benefit, like Richemont has. But at the same time, you need to also get some of the local winners, and there are certainly some local winners in emerging markets, in India, in Taiwan, in Korea. In Vietnam, in China, some great companies, some even great global companies that are winners. So the combination of both the local and global companies, I think, is necessary. Okay, Martin asks a great question. He says, what is your take on Magnus Haystacks view of basically getting all your money out of SA? So I don't know if any of you saw the article that I put out on Times Live about a week ago. If you haven't read it, please read it. I gave 4 reasons why you shouldn't take all of your money out of South Africa. I don't think you should. If you're living in Australia, then obviously there's no point in having your money in South Africa if you're living in Australia. But if you are living in South Africa, I think there's 4 good reasons why you shouldn't have all your money outside of South Africa. So please have a read of that article. One of the big takeaways is that one of the ideal asset classes to have in South Africa is hedged global equity. So you have money offshore and you hedge the currency back into rands. That we can do in our balance funds, and we do it in Skeleton Balance 70, for example. But it's more difficult for an individual to do it, I must admit. But without giving away the other 3 points, I think there are some very good reasons why you don't need to have all your money outside of South Africa. So please have a look at that article, Sygnia, Times Live, and some interesting points there. Sepa asks, why are you avoiding FANG? It's also a good question. It's not that we're avoiding FANG, it's just that we have, FANG makes up, FANG is the top 10 holdings of FANG are very similar to the top 10 holdings in MSCI World, because the US makes up such a big portion of the world index, and because the FANG stocks make up such a big portion of the US index. So it's more about risk management and not wanting to be double exposed to some of the biggest weights in the fund. So we're underweight the US. And part of that, we need to be not hold any FANG to make sure that our portfolios are appropriately balanced. And that's one of the things that's very important from a Sygnia perspective. One of our key DNAs or our ethos or philosophy is that we have a global perspective on all our funds. So it's top down, it's global. It's looking at how much equity you have separate to how much currency exposure you should have. It's looking at factor exposure in terms of US tech stocks versus global tech stocks. And because we have all of our ETFs, we have an amazing ability to take a view and to manage the risk on a geographic basis, on a sector basis, globally. So as we take more and more money offshore, so we can better and better manage the risk of the global portfolios. Even though we're holding passive ETFs, we can still manage the geographic and sector risk and make sure there's the best blend for the portfolio at a low cost. And I think that's our key differentiator. It's a global perspective, and we've got all the tools to manage that risk to get the best risk return outcome for the fund. Anton, pleasure. Thank you for joining. Tom asks, Tom, I'll have a look at your question just in terms of ARC Venture, and I'll get back to you. But that's all our questions for today. Thank you very much for joining, everybody. I hope you have a fantastic April. Lots of public holidays this month, so I hope you enjoy all of them. Looking back historically, not that it's any indication, but generally April seems to be the last positive month before we have to sell in May and go away. So hopefully April is another good month. We'll see. Not too much news coming out in April, and so hopefully it's a relatively steady month, and I will see you all at the beginning of May. Thank you very much for joining. Cheers.